like I would say today, we are still using this transaction channels, but the question is what will be in the next decades. In banking history, we witnessed several serious crises when people were asking if banks are gonna stay alive, and the whole industry will go down. First of the big crisis was in 1825 in UK, where 70 banks failed. Of course, Great Depression, of course, World War, of course, I would say the whole second of the last century, and mortgage crisis in 2008 as well. It brings me to the next thing I would like to talk about, and it's a development of recent financial sector. The recent financial sector has been shaped by several very important changes in the last 100 years. Because banks, as we know them, had to face a big competition from non-banking financial services. These non-banking financial services, institutions providing non-banking financial services, benefits especially from lower level of regulation. This links them to higher profitability of their products with high risk, but rationally ignorant customers are not able to evaluate risk and benefits, as we know, and of course more flexibility in implementing changes. This process is called disintermediation of banking services. Well, the process of disintermediation had taken place since 1850. In this year, like few guys in UK start to think that it's not necessary to have a bank written on your house to provide similar services like banks. So what is disintermediation? Disintermediation means a loss of sovereign position of banks in the financial intermediary. Their meaning and weight have decreased. Banks have lost their position as a institution number one, where people go to deal with financial services. This loss influenced traditional business model because banks lived from interest margin, credit versus debit interest. The rise of competition enables to implement to the banking business model something which we know until today, and it's called fees and commissions. You know what I mean? Fees like for transaction, commission as a provision from transaction. We can divide this disintermediation phase, this disintermediation whole period into 4 phases. In first phase of disintermediation, client bank deposits were withdrawn by investment and mutual funds, pension funds and life insurance funds. We can say that these financial funds were compete with banks and traditional banking products for people's wealth. These non-banking institutions provide products with more flexibility, less level of state control, more anonymous products, and more attractive interest rates. And this process correlates with another process, a regulative process, where central banks in all countries begin to regulate banks a lot. The second phase is very similar, because on the financial markets, households and especially firms have more and more opportunities how to acquire funds to finance their activities. I'm speaking especially about IPOs, initial public offer, where firms started to offer shares in their companies on the primary and secondary market, and that was a great substitute of the standard banking loan for firm. Banks suffered under the increasing volume of regulation, supervision, and legislative changes, especially related to something which is called consumer protection, you know what I'm talking about, and also special laws securing banking stability. Less regulated financial institutions develop new products, of course, with attractive risk and return ratios, and the banks were pushed into the positions that their interest margin as well as interest income started to decrease dramatically. So they, in this second phase, we are talking about a special process which is called diversification, and this diversification means that these fees and commissions were a stable item in the pricing strategies of banks, and it started in the second phase. The third phase is linked especially to technological progress, and this technological progress and breakthrough enables more and more subjects to compete with banks. You didn't need $1 billion to establish something which could provide loans or do financial consultations, etc., etc. And technological progress, I'm thinking especially about telephoning, about online banking and online services, definitely influenced the fact that banks, or led to the fact that banks lost their bank branch network advantage. Banks has quite high level of overhead costs related to branches and branch network. These operational costs are from 70 to 80% related to cash and things that you have to secure cash, you have to collect cash, you have to you have to secure that all branches will have enough cash for their clients, and which means that these overhead costs are rising and rising. But since until the third phase of this intermediation process, the branch network was a great advantage of banks. With the technological progress and rise of telephones and online, this advantage was lost. So the third phase is related to technological innovations, and the fourth phase is related to online and internet rise. During the fourth phase, the technologies definitely changed the distributional channels when selling financial products, and enables very small subjects to I would say, copy and paste results of big banking investments. Yeah. Well, this is a picture which like illustrates the whole process of disintermediation in the US. The picture, the graph pictures shares of financial institutions at the whole US financial sector assets. It's in percentage. This is the commercial bank's share. Yeah. This black column is commercial bank share since 1860 to 1993. And we can see that there is a substantial decrease of the rate of assets US households and firms have in commercial banks. On the other hand, we can see that saving companies, insurance companies, investment companies, and pension funds, yeah, especially these pension funds, are like rising their position on the financial markets. And this process illustrates the disintermediation process on one picture. This is Czech Republic, and we can say that in the Czech Republic, the process is quite different, yeah, because assets in commercial banks are very stable. Yeah, you see the difference. And the question is why? And the answer is, or I can hint you the correct answer, because I can use the two things, two words, B system and M system. There is a pretty big difference between the organization of industry in financial sector. We have two kinds of them. B system is the system with strong banks. Banks are like monopolies or oligopolies. Banks provide most of financial services. Banks have a natural ability to charge more transactions and apply fee policy to multiple clients, because people are used to come to bank, deal with the financial transactions. If you need anything with money, you go just to the bank. Another system is M system. M system or money system is pretty different because banking houses are subject to level or higher level of competition. There are pension funds, there are investment companies, there are saving companies, there are hedge funds, there are like many of them, and people are used to like demand various services from these various institutions. There is a big ratio of diversification in this system. Of course, we can illustrate it on the easy graph. Here is the Czech Republic. And Czech Republic, as well as other post-Soviet countries, could be like mentioned as classic B system, financial system with strong banks and with high relation of clients demanding various services from banking. On the other hand, we have, for example, Finland. Finland is a strong M system because less than 20% of households' assets are held in commercial banks. This is the this is this light blue is like part of the wealth held in shares and investment in funds, etc., etc. Yeah. And you can see that the ratio is pretty different. I have, this is another picture providing the very similar conclusion. Investment and fund shares of households as a part of GDP. And as you can see, this red columns, this is Hungary, Czech Republic, Poland, and Slovak Republic. So Visegrad for all post-Soviet countries, and very, very low level of investments of households. These green columns are countries of Western Europe. I know that it's very small letters there. So this is Belgium, Germany, Italy, Austria, and France. And what I'm just wanted to say is that in the traditional banking business models analysis, it's very, very important to think in what kind of system are you just active. Are you active if M system, you will you have to be ready or high level of competition from non-banking financial services, and if you will implement your pricing strategy, you have to think about one conclusion, that fees and commissions are a necessity for you to stay alive. If you will do your financial business in B systems, like in Czech Republic, Slovakia, etc., your pricing strategy will, of course, implement fees and commissions, like non-interested returns, but this will be a premium for you. And I will show you this table. I'm sorry, it's in Czech. I didn't have enough time to translate it into English, but it's pretty easy. This is Czech Republic, this is Germany, and this is Austria. These are like biggest three banks in every individual country. So in Czech Republic, it is Česká spořitelna, ČSOB, and Komerční banka. In Germany is Deutsche Bank, Commerzbank, and Bankengruppe KfW. In Austria, it is Erste Group, Bank Austria, and RZB Group. This is the net profit in 2011 and 2012 in millions. In millions of national currency. So, like for Česká spořitelna here is like 13.5 billion Czech crowns, 4.3 billion euros, etc. At the second section, we have the same profit deducted by fees and commissions. So if you will like just drop your fees and commissions to the zero, what will happen? In Czech Republic, quite nothing. Of course, your net profit will be significantly lower, but no of these three biggest banks will lost their profit without fees and commissions. And profit of all of them will be higher than billion Czech crowns, with zero fees and zero commissions to the all banking clients. It is pretty impressive. If you do the same for the German banks, you can see that Deutsche Bank with profit 4.3 billion euros in 2011 would go to the loss minus 7.2 billion euros, minus 11 in the next year, minus 2.7, minus 3.0. The only exception is this bank. Do you know this bank? No? It's a state-owned bank, like saving company, I would say. Družstevní záložna v Česku. And it is characterized by, like, I would say, non-market implementing of pricing strategies. Yeah, this bank is like significantly cheaper than others because it's like state-owned. In Austria, it is very similar to these two examples. Like all these banks will or would go from profit to loss, or from loss to much more bigger loss. Yeah, this is decrease of the profit in percentage, which are pretty huge numbers, and it could like show us. I will talk about conclusion later, but it could show us how are traditional banking models built. Traditional banking models are built differently in two types of countries. In which country, in first group of countries, which could be called B countries or B system countries, the banking business model contains of interest income and non-interest income. This non-interest income is a profit premium. In M systems, the traditional business model contains also two types of income, interest and non-interest. But this non-interest income is like break-even income. It is income which help your institution to go from red numbers to black numbers. Let's see another picture, which is like timeline of banking items in Czech Republic and in France and in Austria. I have no Czech Republic on this graph, but which is very interesting. This is the share of net interest income and share of net non-interest income to the assets. This is net interest, net non-interest, fees and commissions. And as we can see, the share of interest income, I mean the interest margin, which is traditionally, historically, the only and core business, I would say business, I'm thinking about the right word, eternity. So, no, never mind. Like, let's say that the interest income were the only business model item, like since the third phase of disintermediation, and in last decades it significantly went down. Non-interest income, fees and commissions significantly goes up. In France, you can see that even non-interest income is much more important than interest one. Yeah, these graphs we already saw. This table is pretty similar to the graph I showed 10 minutes before. I would say household investing activity as a part of GDP. In the red column, color, we see Czech Republic, Hungary, Poland, and Slovakia, with numbers like 35, 60, 60, 61, 72, 98, 93, 90, 120, 105, 121 in the Czech Republic. And we have Western countries like 345, 332, 180, 200, 260, 290. I mean that it proves also that the investing activity is much more higher in M systems than in B systems. Well, and now about the fintech. Will the fifth phase of the disintermediation happen? I am saying definitely yes, it will. And we witness the fifth phase right now. Because the relation between financial technologies, people with experiences from banks, and ability to provide faster and cheaper services concludes to the only thing, which is the rise of fintech. Fintech, I'm pretty sure you are familiar with this blend of words. Financial technology is a progressive industry with providing disruptive innovations to the banking industry. Why? Because users of fintech are B2B, B2B for non-financial entities, B2C for consumers, and of course consumer-to-consumer platforms. You want to pick a photo? No problem. Well, Google Trends analysis and two words, two terms. Fintech, which is blue, and driverless cars or autonomous cars in red. And we can see that the bubble under the word fintech, it's much more higher than bubble after bubble related to driverless cars. Well, let's briefly see the top 10 fintech startups in 2016. We are running out of time? No. Okay, I will have like 2 slides. Yeah. These are top 10 fintech startups in 2016. 8 out of these 10 are related to services provided by banks. Social finance, refinancing student loans, Billguard, detecting bank charges, controlling consumer spending, so financial consultations, Square, processing small card transactions, robotic investments, consulting, portfolio management, online trading, peer-to-peer lending, payment system that use mobile applications to scan the cards, application that enables creditors to effectively manage receivables, investment into growing companies before IPOs, possibility to finance special projects in public space. I mean, those are literally fields that banks have a monopoly in last decades, but they are losing their positions. Fintech business models is based cashless and facing traditional financial services, as I said, because fintech business model have 5 very special items. It is definitely low cost. It has emphasis of innovation, combined with know-how of founders. Many founders have some experience from banking. under the lower level of regulation, significantly lower level of regulation, and of course driven by investment bubble, which is related to any industry, which is like very medially and financially attractive. In a brief comparison of these two business models, we can see the very clear advantages of fintech. It lays online, needs no branches, has very small overheads. Some global companies have less than 50 employees. So in comparison with banks, there is a significant difference. And fintech companies implemented very efficient pricing, like payment per transaction, complement income, strategic partnerships, which is pretty different in comparison with banks. So to make a conclusion, I think that traditional banking is over or gonna be over because these fintech business models will take part of the traditional banks. Banks are like banks in M system have no space to cover the loss with fees and commissions. Banks in B systems have some space, so the change will take a longer time here, but we are leading to the fintech world with cashless society. And I will just lose few words about this idea, which is very provocative here in this room. When I said cashless society, I mean like society without cash, like we know it today. Fiat money cash. Cashless is not fiat money cashless, but cashless means like with digital money, and this digital money could be crypto digital money. I don't mind it, and I believe it will happen. But this revolution will change our wallets, no, not our thinking. Economic theory says that cash demands motives are three. Transaction one, cash as medium exchange. Precautionary one, cash as tool to cover unexpected situations, and speculative one, cash weights risk resulting from ownership of other financial assets, like diversification of risk. And these fintech solutions can cover any of these three motifs. So that's I mean that integration of fintech ideas is completely digital, and it will spontaneously squeezes out cash transactions from the market, because this is not regulatory based, but this is market oriented revolution. So that's just, I promise that I will cover off also the topic cashless. So that's why I'm here right now. Yeah, that's pretty end for me, and I'm open to your questions or comments, of course.
Thank you very much for your speech. And I would like to have the first question to you.
Okay.
You were talking about the B system and about the M system. I want to ask you, what do you think is behind it? It's really just like that some of the countries are just rich, so the households can afford to borrow monies? Or do you think there are even some other influences which determines if the country is in the end B system or M system?
Yeah, this is a good point and smart point, because if you have no money, you can invest no money, of course. But I did a research on this field, and I found quite strong correlation between factor post-Soviet or like Eastern European country, and B system, which led me to the fact that this 50 or 40 years we lost under the communism with only one state bank and with no experience with like financial diversification of your household portfolio has a significant effect here. And we have to add another thing, that in 1990s, where we got the freedom to invest, many of households were I would say misled by some like bad banks, bad coupons, bad shares, because they had no information, and their first experience with investment was totally bad. So that's why like biggest 3 banks in the Czech Republic have, I would say, 2/3 of household assets on their accounts.
So if I understand it right, it's probably more about mentality than about having money.
Yeah, I would say.
Thank you.
This is the
now, if somebody have a question, I will give the microphone. Yeah.
I missed some comments on Ph.D. I think that is also an extreme opportunity for fintechs.
Yeah, like.
What's your idea about that?
For me personally, that's one of the reasons I co-found a fintech company, which provides prepaid payment cards to the public, and combine it with Bluetooth low energy technologies like beacons, because this location-based analytics and location-based services combined with approach on the banking information, which will provide PSD2, and with people holding your payment, it's a big opportunity for these fintechs. And I had several talks with several banking managers, and they are very afraid of PSD2. If you talk to any owner to fintech company, these people are extremely happy. Yeah, so this is the reason of one of these research fintech report, and it says that like 73 of bankers fear that fintech will dominate consumer banking. 73 of top managers of banks. 89 of banks want to integrate some fintech companies into their business structure. And 73 of bankers think that fintech is the opportunity to reduce their costs. Yeah. So 32 banks are planning to invest into fintech companies. So I mean, this all like provides to put long story short, yes, PSD2 will be extremely opportunity for fintech, and it will be a big punch to traditional business model issue.
Sorry, what's the name of the company?
Paynovatio is a company providing these payment cards, and Retail Track is the company oriented on the location-based analytics and location-based services. Yeah.
You spoke about the cashless payment at the end. How do you think that will work out? Do you think that the bank will agree on another money that will be, for example, Bitcoin? Do you think that can work out great or not?
Yeah,
they will lose power. They will lose power.
If I understand clearly, if the Bitcoin and other cryptocurrencies will suit to my prognosis of digital society, right? Yeah, absolutely yes. When I said that I am believing in digital cashless society, I said that I believe that all these all these smart people and all these hundreds of investors investing hundreds of billions of dollars every year will make the change happen because it's a market-oriented. But I am pretty sure that all these companies are ready to implement any crypto or digital currency into their business because it's just a matter of demand and supply. So I'm definitely like pro Bitcoin and pro other cryptocurrencies, and I think that this will definitely take place in the digital revolution we are witness.
What strikes me is that, for example, if you take the JP Morgan CEO, is saying that Bitcoin is shitty, let's say, but on the other hand, is really investing into cryptocurrency or crypto blockchain projects. So it's like on one hand they want to invest into fintech, but on the other hand they don't want to lose the control on the money.
Mm-hmm. Well, I don't know what this guy said, but I know other bankers in the Czech Republic and in Germany, for example, they are saying like shitty things about Bitcoin and cryptocurrencies, but they own their own like crypto money, and they just saying it on purpose because because like their business and their positions are related to traditional banking, and every year you will stay alive in this top position. It could like mean substantial income for the next generation, let's say. So I would say that many of these like speeches are on purpose, and the system will change the mind like this when the time comes.
Well, I wanted to already end it, but here is one last question. So I would just ask you for a really fast question and a really fast answer, because the next talker will come soon.
A fast answer on the regulators, I think also connected to the Bitcoin and crypto coins, like in the UK, they're providing some kind of sandbox where they can get in touch with the fintechs and adopting coming regulations. Any ideas on that or thoughts?
Like I like maybe I will put this down because I didn't see your question properly.
No, regulators. Regulators in the UK, for example, are providing some kind of sandbox, and there's talks about that in Sweden too. Talking to Finansinspektionen, they have a wish to provide a sandbox to invite fintechs and adopt to cryptocurrencies and getting a dialogue on the issues.
And the question is if the same happened in Czech Republic?
Yeah. Do you see this in other places?
Yeah, I'm like I was attended several events like this, and I must say that like for example my fintech company, and I know that also other fintech companies are not very happy to come to these events because in one such event there were problem with know-how and with like NDA, and like one bank starts to develop our product because we just presented the product on the event like this. So I would say that many fintechs will just go separately and go in touch with banks or other institutions just in case the...
So stay away from the sandbox.
Yeah. And the product is, when product is on market, it's okay, but in the phase of like seed capital, it's better to keep it just in your head or in your computer, I would say. Yeah. Okay. So thank you very much.
Thank you very much for your speech, and have a nice day, everybody.